The economic impact of heightened geopolitical tensions in the Middle East is being felt all around the world. In South Korea, the effects are being seen in the financial markets and oil prices. It's the topic of our business segment this week. Our economics correspondent Moon Hye-ryeon joins me in the studio. Hi, Hye-ryeon.
Good evening, Jung-min.
Evening. Tell us to what extent the recent conflict between Iran and Israel has been affecting the economy at home.
Well, Jung-min, let's begin by talking about the currency exchange market. The South Korean won has been sharply depreciating against the greenback over the past 2 weeks, with the US dollar strong in markets around the world. Recent data has shown that the exchange rate between the two countries has risen by over 7% this year, and this rate exceeds that of the rate seen during the financial crisis of 2008. International oil prices, too, have seen a sharp hike. Last week, oil prices shot up. The global benchmark Brent crude oil surpassed $90 per barrel as Iran and Israel traded direct attacks against each other's territory for the first time. But oil prices have been fluctuating this week following Israel's limited retaliatory strikes, with traders dismissing the possibility of a sustained war between the two sides and the likelihood of the Strait of Hormuz being cut off. The country's benchmark Kospi index also saw a sharp decline. Last Friday, it dipped below the 2,560 mark for the first time since February. This comes as foreign investors seek safe haven assets, but one expert says another big factor has been hawkish remarks from Federal Reserve officials.
For high-tech industries, the interest rate is very important for their investment plans. So with longer period of high interest rates, that they may scale back on their investment plans, and that's showing up in the stock prices of high-tech industries.
How are the authorities responding to these so far?
Well, the government has been fairly quick to respond to situations as they've been unfolding. And last week, Finance Minister Choi Sang-mok met with his counterparts from the US and Japan in Washington, D.C. and addressed concerns over the sharp devaluation of currencies against the dollar. And here's what he said.
Our three countries need to cooperate to actively respond to the financial instability that real economic uncertainty can cause.
The governor of the Bank of Korea also commented that the volatility should be minimal as long as the situation in the Middle East does not get any worse. And he wasn't wrong. Looking at the $1 exchange rate this week, it's been less unstable compared to immediately following the attacks last week. More concrete action has been taken regarding oil prices, with the government extending the fuel tax cut to June. It was due to expire at the end of this month. And one expert says that this measure could help households manage their expenditures.
Given that the food price has soared a lot in the several months, I think it is certain that not abandoning the current policy will be helpful for households, since it lowers the transportation costs, which can directly improve the consumer's welfare.
Hye-ryeon, why should the country begin to prepare going forward?
Well, the government and many research organizations are preparing for various scenarios that could unfold in order to get a better picture of how the conflict could develop and how it will affect the country's economy. So the main concern regarding a hike in oil prices is how it could get in the way of bringing the country's headline inflation down to the 2% range by the end of the year. The Federation of Korean Industries gave 4 different scenarios based on past case studies such as the 1973 oil crisis. If crude oil stays level at around $88 per barrel, consumer prices could rise to over 3% by the 4th quarter of this year. But should active conflict break out and crude oil prices rise to over 3 digits per barrel, consumer prices could rocket up by more than 4%, and experts say that a fuel tax cut won't be as effective. Here's what one expert says. Given that the core inflation rate excluding food and energy prices has been stable at around 2.5% this year.
So this figure is the lowest level since 2022, implying that the price level, excluding the energy products, has stabilized a lot during the last 2 years. So given that the price level has become already stabilized a lot compared to before, we can expect that the effect of the tax cut will be somewhat limited.
There is also a need for the government to consider how supply chains as a whole could be affected by conflict in the region. And this was diagnosed during a ministerial economic meeting earlier today. Finance Minister Choi Sang-mok described the supply chain as fragile as thin ice and highlighted the importance of a strong supply chain that many of the country's high-tech sectors are reliant on.
All right, thanks for the report, Hye-ryeon.
Thank you for having me.